It is Thursday the 5th. Good morning. On today's agenda, the tech sell-off expands, the shiny stuff slumps again, and it's another blockbuster earnings day.
OK, Tom, let's talk about the volatility we're seeing. It continues in so many asset classes, and you wonder whether or not this starts to connect, whether or not the overall volatility story becomes a problem for markets. Silver's down 11%, completely reversing some of the positions we saw earlier on in the week as we bounce back. Bitcoin's approaching 70. Strategy reports numbers after the close today. Keep an eye on what it has to say later. It's down by 2.5%, Bitcoin. The European equity picture looks quite muted at the moment, a sea of calm, you could argue, in what is otherwise a very volatile picture at the moment. Can you, at the moment, are you trading this as a sort of bottom-up earnings story, or is it a top-down kind of strategic story? I think that tension's going to become really clear as we work our way towards the opening bell this morning. Euro Stoxx 50 futures currently down 0.1%. The countdown to the opening trade starts right now.
Good morning, everybody. This is the opening trade, just gone 7 o'clock here in London. Let's start with the tech sell-off. We've got plenty of earnings here in Europe to get to. We'll do that in a moment, but we'll start with the negativity around tech. Another day where software was under pressure. It was big tech, it was small tech, a lot of it being sold off, and rotation into value seemed to be the theme of yesterday's session. But there's no shortage of voices lining up to say, hang on a second, has this sell-off in software gone a little bit crazy? JP Morgan saying this is as if the whole sector has been sentenced before it's been tried. Jensen Huang saying this makes no sense. AI will use software as a service. It's not going to be reinventing it. And Sundar Pichai saying over Alphabet saying that AI is going to be an enabler of SaaS. So suggesting there is some symbiosis between software and AI. Where exactly that falls is really the question the market is asking.
Don't know. That's the problem, isn't it?
That is the problem, and I think what really was in focus yesterday was this spread from the software to the chip makers. For the last few weeks, it's all about software versus the chip makers. The chip makers have held up until yesterday. AMD tumbled double digits. You saw pressure for Nvidia. You've seen a similar picture over in South Korea. The SK Hynix obviously under pressure today, and the South Korean Kospi, I should say, with SK Hynix in the mix. So the chip makers are now under pressure as well. This has spread. I think Alphabet's earnings were really important. We seem to be in a moment where investors are a little bit like Goldilocks and the Three Bears. It's either too hot, the AI story, or too cold. Maybe where it's just right is with Alphabet. And you could make the argument, given what's happened with the cloud business, up 50%, given what's happening. Yes, the CapEx spend, 185 billion, more than the previous 3 years combined. But cloud is working for them. Advertising is working for them. They're selling chips, and they're using their chips for Anthropic. They're selling their AI into Apple. Is Anthropic where you want to be in this AI trade?
I mean, Alphabet has had a really special place, hasn't it, in the performance of the markets recently, because Alphabet's been up 25% over the last 3 months, when a lot of the other Mag 7 have been falling over. So interesting to see where this one goes. And to your point, maybe flat performance after hours is a win in this current environment.
The big fear is that we are seeing this rotation out of tech into value. And you've seen that before.
Isn't that a healthy dynamic for the markets?
Could be. Happened just before the year 2000 massive sell-off. So that's a fear. That's a worry. Is this a repeat of what we're seeing there? Can the index level maintain the position that it's at if the big tech sell-off continues? That's a problem for US consumer spending, for US consumer confidence. That's a macro theme that starts to work its way through as you see the wealth effect being hit. Kind of all of, there's a ripple that comes out of this. What stays in the software sector does not stay in the software sector for long. Let's talk about where else we're seeing volatility, and that is precious metals once again. So let's talk about dead cats. Dead cats have bounced, and now they are falling once again. And that seems to be the narrative coming out of the silver market. It's a very, rubber cats. And that's what we're seeing right now. Silver had this big retreat. It bounced. There were people that wanted to get back in, the people that thought that it was a trade that they could get back into at a better price, and now it's fallen again. This kind of volatility. Does it stay in the precious metals market, or is it we're seeing a series of volatility events? Are they connected?
Well, yeah. We've talked about precious metals a lot and the way that it's traded, and it's really interesting because yes, it can be a haven, but on days where you see it fall a lot, it doesn't necessarily. It can be also a very risk-off signal, and maybe that is what we're seeing. But the size of the silver move leads some to suggest that this is quite specific. Gold is also in the mix as well, but silver is so outsized. It is in danger of unwinding everything it's done in January, which has been a huge amount.
Can I just because I know you want to talk about oil, let's just talk briefly about Bitcoin as well in the mix. The retail trade in America. The retail trade around the world, how much is it hurting right now? And again, I bring this back to consumer confidence. This has been an area of consumer confidence that has driven consumer confidence. The ability for these markets to go up has had a massive impact. Bitcoin's not doing that again. Strategy's going to report numbers after the bell. Pay attention to that as well.
And the fact that both are down, because there have been a narrative that maybe some of the money in Bitcoin had been moving into gold. Instead, of course, gold is under pressure. It's paired some of the heavier losses. But Bitcoin now down 2% at around 70,000, that level. We haven't seen these kind of numbers for Bitcoin since around November of 2024. You pointed out Micael Saylor and the Treasury effect there and whether or not that will came through in the earnings for that business later. But where is the support for Bitcoin is another factor. And to your point, Anna, oil is under pressure, now down about 2% as well.
Yeah, been a wild ride in 24 hours for that one. A momentum unwind, it seems, on lots of different assets this morning. Let's talk about Shell, shall we, Tom? We've got numbers coming through there. Adjusted profit coming in below estimates, actually, but announcing a share buyback of $3.5 billion.
The share buyback is there, $3.5 billion. There's been some questions over the analysts as to how much they can support the buyback. There's a big focus, of course, in terms of how much they have in the pipeline going forward for Shell. So that's going to be part of the question, certainly, when we speak to the CEO later. But what we're talking about in terms of free cash flow, you're seeing fourth quarter cash flow from operations of around $9.44 billion. That's above the estimates. Dividend per share, that's coming up a little bit on the estimates, 37.2 cents. That's dividend per share. Adjusted earnings, 57 cents. So below the estimates, pretty significantly on the adjusted EPS. We've got a print there on debt coming in slightly below than the estimates. But it's the buyback, and to your point, Anna, is the profit, of course, coming in below the estimates as well. $3.26 billion for Shell.
We'll talk to Maersk in a few minutes' time. Underlying EBITDA, the range for 26, 4.5 to 7. The estimates, 5.76. So basically, big range. They're kind of the estimates right in the middle of it. But this is based on a gradual reopening of the Red Sea. We are going to speak to Vincent Clerc very shortly.
Yes, and Maersk saying they will focus on cost discipline, which takes us to our next story, another company that is focusing on costs. Turning to another earnings story from a different sector, BNP Paribas has reported a beat on fourth quarter profit and raised some mid-term financial targets. France's most valuable lender also disclosed new plans to focus on costs. Cost savings of €600 million in the current year is now the focus. Joining us now, Lars Machenil, the CFO of BNP Paribas. Lars, really nice to speak to you. Thank you so much for joining us this Thursday morning. So, revenues better than expected, net profit the same, loan loss provisions coming in lower than expected, raising midterm targets. All sounds pretty good in terms of those numbers. What is driving the confidence that enables you to upgrade guidance for the second time in just a few months?
Yes, good morning. As you mentioned, the synthesis is we're really strongly delivering on growth. If you look at the bottom line, it grew by 28%, so it's almost $3 billion in profit, a record for fourth quarter. So what's driving this? It's basically the pivot. The first, if you look at our three divisions, the CPBS, which are our networks, we basically reached a pivot. We spoke about this pivot as we are operating in a fixed rate environment. So we said it will take some time before the pickup in rates translate. Now they are translating. That's the pivot. And that pivot is there to stay for several years. And so we really have that strong growth. And then there is the other department, which is called IPS, which is asset management insurance, which is also pivoting, but pivoting in scale. It has bolted on the AXA IM and now is becoming a global asset manager, and the top line is up 40%. So those are the things. So our businesses are delivering as we planned. And then we've also announced that as we come out of a series of integrations, that we have to review the setup end-to-end of our functions. And so that will further upgrade our service and optimize our costs, and all things together lead us to upgrade our 28 targets.
Okay. So interest rates flowing through with a bit of a lag, Lars, and some expansion in some parts of the business, increasing scale. But let me ask you about the cost side and how technology can help you here. We spend all day, every day, it seems, talking about AI now. I noticed that you've got new cost-saving targets. I wonder how much of that is going to be driven by employing new AI technologies.
Yeah. We have been bolting on AI, let's say the machine learning aspect has been in, and it's one of the drivers why we operate at positive jaws, right? The thing is, what we will do in the years to come is that we will further step it up, in particular now also the generative part, where we can look at some end-to-end processes that we will optimize. So today, the main impact, the main improvements that we have on AI are in the revenue department. What we now see in the process review that we will launch is that there will also be an impact on cost and cost of risk. The underwriting process, by injecting AI, can be further updated. So those are the levers that we anticipate to capture in the years to come.
Lars, how many jobs within BNP Paribas do you think can be done by AI right now? How many jobs going forward? The fear in the market right now is that white-collar jobs are going to disappear. Do you agree with that view?
Listen, if you look at the overall setup, what we have today, and for the numbers, you will have to come to our Capital Markets Day next year. But if you look at it, the overall setup will be modified end to end. But don't get me wrong, you know our approach. That what it basically means is that we will use natural attrition to get to optimized levels. So yes, maybe the overall staffing requirement will be less. We will get there through natural attrition. But then if we look at the overall economy, those jobs will be redeployed in other activities because the AI will also generate totally new activities. I mean, let's go back. It's what the internet did. It's whatever, all of these things that we've seen, it leads to a change in kind of activities. And that is what we anticipate.
We are seeing huge amounts of volatility in the market, the silver market, the gold market, the rates market, equity markets, tech stocks. Lars, is that a benefit to BNP, or do you worry about that? Is that good for your traders? Is it bad for the business? I'm wondering how you're looking at the volatility that we're starting to see in 2026.
Yeah, well, I take your question along two axes. If I look at the traditional kind of business, you look at the corporates and the institutionals, for them intrinsically, and we are serving Europe. Europe overall is bouncing back. You see the growth is there, inflation is where it should be, rates are where it should be, Europe is investing. So overall, maybe one country, maybe one sector, but for a bank like us, which is diversified, this is basically very fine. So intrinsically, that uncertainty is overall in Europe delivering growth. But then you look indeed on the activity, which is then more the trading activity related on how people want to hedge and how they want to do. And there is indeed some uncertainty that you see. But that is a bit a generic uncertainty that you typically have. People are thinking in what forex should I be, what commodity should I be, and these kind of things are an overhang. But this overhang is basically triggering demand because one day it's going in this direction, it's going into another direction. So looking from the stance of what our clients need, be it corporate, be it institutional, be it trading, we see a very positive demand. And so that is why we feel comfortable accompanying that growth and therefore growing ourselves.
Specifically, I was just pushing on that. The trading business is set up well with this volatility then in the quarters ahead.
Listen, with what we see today and the demand that we have, there is an uncertainty. But you know how it goes with uncertainty. Uncertainty drives the demand. If there is too little, there's basically nothing. And there can be occasionally too high volatility. Such a volatility intraday that basically nobody dares to move. The volatility we see today is in that right middle. So from that point of view, it is positive.
You talked about Europe being back in terms of the growth pitch. Is France back as well? Is the relative political stability in France going to be a benefit for your business going forward?
Don't get me wrong. And I have this gimmick of saying we have twice Paris in our name. And yes, we're domiciled in France, but we are basically a European bank, right? 70% of our earnings are Europe. There's only 10% of our pre-tax that is in France. But we see positive things in France. Yeah, there's a positive momentum when we look at household consumption. It's expected to grow. The business climate is rebounding. Moreover, France has a budget. It's going in the right direction. I'll put it in another way. Yeah. If I look at our commercial bank in France, revenues are up by 5% in the fourth quarter. Yeah, just to show you how we read that improvement.
Can I just pick up on that? French PMI is below 50, CPI way below target, consumer confidence is pretty on the floor at the moment, fiscal drag is coming. If you could pick up the phone to Christine Lagarde right now, would you say that France could do with lower rates at the moment?
If the thing is, if you look at, I agree when you observe the indicators. However, you should look at the derivatives. Yeah, as I said, the pivot is there. The pivot is what we basically see that is happening at this stage. Should there be a lower interest rate environment? I think the logical numbers, what you see, there is a bit of a trade-off. Is the pickup strong enough or not, or will it be a support? Listen, we'll see this afternoon, but it's not unlikely that this would hint at a slightly lower rate environment.
OK, well, we'll keep that in mind. Lars, just to finish off, going back to the business of BNP specifically, we know, of course, that the case that started in Sudan is being heard by a New York court, and there's an appeal process underway. What is your attitude to taking provisions ahead of a verdict on that?
Listen, the decision on January 8th, basically the court allowed us to appeal. And that will be filed by Monday, February 9. And so we are fully prepared for it and confident in the strength of our arguments. So that's basically where we stand. There is no change. We'll take it now in the months to come.
So no provisions as yet?
Indeed.
OK. Lars, on that note, we will leave it. Great to catch up with you as ever. Thank you very much indeed, Lars Machenil, the BNP Paribas CFO. For the eagle-eyed amongst you, you may have spotted a little graphic appearing at the bottom of the screen that says that BNP's cost savings will be €600. That's a very small number. The actual number is actually 600 million euros, which seems like a more realistic number and one that might actually move the dial. Yes, sounds a bit more convincing. Coming up on the programme, another day packed with earnings interviews, of course. Shortly, we'll be speaking to these CEOs, the CEOs of Maersk, of Shell, SAAB and DNB. So lots to stay with us for. We'll also not lose sight of broader investment strategy and a tech theme. So we're going to be speaking to Shanti Kellerman from 7IM. That's at the Open. Where does she think the software sell-off goes next? And we'll also be talking AI and that software sell-off with Anish Acharya, who is from Andreessen Horowitz. Great conversation to fit in this morning, Thursday, 5th of February. Up next, a look ahead to today's central bank decisions from both the ECB and the Bank of England. If you have questions, please get involved. IB plus BBTV Go. That is the function to use today and every day on the Bloomberg terminal. This is Bloomberg.
After nearly 5 years of above-target inflation, it is essential that we maintain our credibility by returning to a disinflationary path and achieving our target in the relatively near future.
Fed Governor Lisa Cook. Important statements. She is so important to the future of the Fed right now. It feels not only on the policy front, but also on the relationship with the White House front. It's going to be very interesting to watch what she says and does over the next few weeks and months. Turning to Europe now, we've got key central bank decisions that we need to watch here as well. The ECB is going to deliver its decision on whether to keep interest rates on hold a little bit later on today. We just heard the CFO of BNP Paribas maybe hinting at the idea that France could do with lower rates. Does Europe need lower rates? Let's find out. Lizzie Burden is in Frankfurt. Lizzie, what do we need to know?
Well, I don't think he's going to get them any time this year or next. At least that's the expectation among economists and analysts, Guy. The ECB expected to keep rates on hold today at 2%. And that latest growth figure for the fourth quarter giving cover for the Governing Council to stand pat here. If you think back to all of that hawkish hype that we had from the Isabel Schnabel comments and the market reaction to it just a few weeks ago, that has faded now for three reasons. First of all, you've seen inflation undershooting the target. Secondly, you've seen euro strength past the $1.20 mark briefly last week, but that, of course, is the level that the Vice President Luis de Guindos said complicates matters for the ECB. Those comments, surprisingly frank comments, last July. And the Bank of France Governor François Villeroy de Gallo actually saying that it is going to be one of the factors that will guide monetary policy. And, of course, the danger being that it damps exports or embeds the inflation undershoot. And then, of course, thirdly, you've got the geopolitics and President Trump renewing the tariff threats on those opposed to his Greenland plans, even if those threats were walked back. But there remains this lingering trade uncertainty that could weigh on consumption and investment in the euro area economy. So all three of those things are downside risks. I wouldn't expect Christine Lagarde to be leaning into the hawkish side of things today. I spoke to the Austrian Central Bank Chief Martin Kocher last week. He says they need full optionality to be ready to act when needed. So that is the tone I would expect to hear from President Lagarde today, Tom.
OK, Bloomberg's Lizzie Burden on the ground for us in Frankfurt ahead of the ECB meeting, of course, and that ECB rate decision at 1:15 p.m, followed by ECB President Christine Lagarde at 1:45. And at 12 p.m. UK time, the Bank of England will announce its rate decision with BOE Governor Andrew Bailey speaking at 12:30.
Yeah, I'll be here with that special coverage of the Bank of England rate decision. Now let's talk about the markets in 3 minutes. Joining us live, our Markets Live executive editor, Mark Cudmore. And boy, where to start, Mark? I mean, let's start with the sell-off in tech, shall we? Sell-off in tech, sell-off in software specifically, but also some of the big tech names, a move into value, ending some momentum, or winding back some momentum trades. What was your take on what we've seen over the last few days?
Yeah, the price action's really been quite remarkable. I think there are a few kind of tangents to get about this. First of all, the price action so far has seemed very much like a rotation in stocks. There's been some really dramatic moves globally. But overall, most risk assets, and there are some notable exceptions, have traded relatively okay. I wonder whether that starts morphing into a bit more broader risk aversion. I think what we might see is the hardware AI names catch down to the software AI names rather than AI software catch back up. So I think it might turn a little bit more negative. Two concerns there. I think, suddenly private markets might come back into focus. We saw a little bit of that yesterday, but that software bit is getting people more scrutiny of what's happening on the private equity side, private credit side, private debt side. So I think people are going to get a little bit more worried there. And the retail names are just getting destroyed between what's happening on precious metals, the big favored tech names, and of course in crypto as well.
Mark, can I connect the dots? I've got a series of big volatility events that are happening at the moment. Metals, as you say, what's happening in the energy complex, what's happening in the software space. Can I connect these events? Do they form a bigger picture at some point, or do they remain isolated?
You might be able to connect them. I'm struggling to. I'm trying to.
Yeah.
I think that obviously there's always some interrelation between price action in markets. I don't think there's one overriding theme. As I said, there's the kind of what's happening in the software space, which is really about, the evolution of the AI trade. At the same time, there's the kind of the retail sector momentum stocks that just are momentum trades that just got so kind of overextended, and that kind of led in the precious space. Now, I think both these are probably weighing into what's happening in crypto and stuff. So there's some interrelations, but I don't think there's one overriding theme. I think into next week, this might all evolve into one overriding theme of just a bit of risk aversion. Not a bigger panic, but just a bit more of a correction than we've seen more broadly.
OK, that sounds easily managed. Mark, thank you very much indeed. Mark Cudmore, our executive editor on the Markets Lime team. Coming up, we're going to turn to navigation of a different sort. Maersk CEO Vincent Clerc is going to be joining us to discuss the logistics giant's latest earnings and critically outlook. The big focus here, the Red Sea, but we need to talk about Panama. What's happening in China? So much going on in his space. We'll do that next. This is Bloomberg.
Welcome back. We are 30 minutes from the start of the opening trade. Let's check in on futures then after another rough day in terms of the tech story over in the US. That rippled across to Asia as well, particularly over in South Korea. The cost will be down heavily. Today, futures in Europe looking a little bit more stable. Year to date, you're still seeing gains of around 4% for the European benchmark. 50 futures then pointing a little lower by 0.1%. FTSE 100 futures pointing lower by 19 points, down 0.2. We keep an eye on oil, of course, under pressure in the session, as are the precious metals. Nasdaq 100 futures, though, seemingly turning around again after a lot of selling yesterday, kind of pointing up by 0.3%.
Yeah, another day where the overall market moves perhaps don't do justice to the news flow. That's the thing with rotations, I suppose. Let's have a look at the bond markets, and we are seeing yields a little bit higher across these European bond markets. Yes, we haven't got gilt markets open yet. We will certainly tune in for those, or tune our antennae into those in around half an hour's time, of course, given the political movements around Peter Mandelson and all the impact that he's having on the UK political landscape. A lot of drama yesterday, and we saw some of that playing out in gilt markets. We were up by 6 basis points at the long end of the gilt curve yesterday on, which should we say, it's not expectations of a change at the top for the leadership in the UK, but there is that theme rumbling about in markets, and so we'll certainly keep an eye on how that develops.
OK, let's talk about navigation and figure out exactly what is happening on that front. Maersk out with numbers this morning. The full-year EBIT number looks pretty much in line. The Q4 numbers, there's areas of weakness, there's areas of strength. But what really stands out is the guidance going into 2026. So Maersk sees 2026 underlying EBITDA, 4.5 billion to 7 billion. That's a dollar number, I think. And it's got a 2026 underlying EBIT loss of 1.5 billion to a profit of 1 billion. Those are really big ranges. Let's talk about navigation with the company's CEO, Vincent Clerc. He joins us now. Vincent, those are really big ranges. Why are they so big?
I think the reason why the ranges have to be so big when you look at 2026 is still the big amount of uncertainty that there is around a couple of key fronts. And it all revolves around shipping rates, so the prices that we will be able to take. After a few years following COVID of bumper profits and historically high freight rates, we're seeing a normalization now with big investments in tonnage coming online ahead of supply, and as you mentioned, the Bab el-Mandab Strait reopening, and we expect more and more services to go through the Red Sea again, which will free further capacity, and we expect will create a pricing environment that will be under pressure for the shipping division. So that and the uncertainty that there is around the timing of how this is going to play out means a pretty large range, as you said. The rest of the business, though, continues to progress. Underlying demand for the services that we provide, whether it is in shipping, in terminal, or in logistics, remains strong. There's good opportunities for growth. There's good opportunities also for further margin progression. The one thing that is a big question mark is the freight rate environment, the pricing environment in the shipping. OK. And that's going to be determined by, amongst other things, the Red Sea, as you say. What's your level of confidence that the Red Sea is going to continue to reopen? We've got Iran-US talks taking place over the next few days. Huge amounts of tension in the region. We've got a carrier group from the US that's just arrived. What is your level of confidence that that Red Sea story is going to evolve kind of as anticipated right now? Yeah, so I think let me start with the situation in Gaza, which clearly is making progress. We've seen the reopening of Rafah, and we seem to be moving into the next phase of the reconstruction there. So clearly the temperature has come down, and there has not been any attack for quite a few months now. That's why we have re-announced, after a few trials and a few ships sailing through the Bab el-Mandab Strait, we have announced that we are going to have services now returning permanently through normal sailing routes. The first two with a date on them, the next two have been singled out, and the dates will be communicated shortly. So that will actually put a significant amount of our deployment back through the normal sailing routes. And we do this because we actually believe that the direction of travel, first of all, today is safe. And second, we believe that the chances that this will continue to move in that direction are much higher than the opposite. Now, as you rightfully point out, there is also a new situation playing out between the US and Iran, which we're following very closely. And we're going to act very prudently. If this was to evolve in a negative way, we can undo some of the decisions we have made so far. But overall, after a few years of absence from the Red Sea and sailing through the Suez Canal, we believe that the time has come now. The conditions are in place for a return.
Okay, the conditions are in place. Good morning, Vincent. You touched on the supply-demand dynamics, more tonnage coming on. Can you give us more details into how you see that story evolving? How much more tonnage and what does that do? You talked about the uncertainty around pricing. When do freight prices start to find a floor?
Yeah, so we've seen them erode actually over the past 2 quarters, and that has been one of the key feature in if you look at the year for why the first part of the year has been actually much stronger than the second part, and we're obviously headed into a 2026 with that background. Even though market demand and global trade, despite talks of trade war and so on, has shown incredible resilience with markets growing 4 to 5% during last year and continue to expect to grow 2 to 4% in the coming year, we're seeing capacity coming online at the clip of 5 to 6% during 2025 and another 4 to 5% in 2026. And if the transition back to the Red Sea happens, you will see another 4 to 5% being released. So you will get a significant overcapacity, which we expect will put temporary pressure on the freight rate. Shipping is a cyclical business. After very strong up cycles, you have to get through a few adjustments, and I think this is what is going to play out, or what we expect in our guidance to play out already in 2026.
Does that significant overcapacity lead to consolidation in the sector?
I think the first thing that is going to lead to is more discipline when it comes to capacity management. No ship has been scrapped for the past few years because of the incredibly high prices that we could get. It made sense to sell everything. As a consequence, a lot of the fleet is old today, needs scrapping. So I think there is a lot of that needs to happen. We can also invest more into cost efficiencies through deployment of slow steaming and so on. And we might see a bit of consolidation, although I don't think that it is immediately in the cards because of the strong balance sheet that most of the carriers are heading into this down cycle.
Vincent, good morning. Let me ask you more about that cost-cutting measure, or those self-help measures that you can put in place. What is it that you can try to do to insulate Maersk from this volatility? We've seen that you've talked about cost-cutting and job cuts.
Yeah, so we've done a few things already. So we feel we're very prepared to whatever is going to come at us. The implementation of a new network during 2025 has meant that we can generate cost savings close to $1 billion a year on the shipping network that we're deploying today because of the increased asset intensity we can generate and the increased also quality of service that we can provide to our customers. We're going to continue to work on this. There is more work that can be done. The other thing that we do always is a very, very sharp focus on productivity, deployment of new technology here under also some of AI, which means that we can accelerate some of the productivity gain we've been on path to do already for the past few years, and that continues to be a focus also in there. So I think we have quite a lot of opportunities still on the cost to do more, but we also get into this down cycle in very strong shape, and with other businesses in logistics and in terminal that have been extremely strong and will continue to provide very strong financial cushion as we head into this down cycle on shipping.
Yes, let me ask you about that land-based business, Vincent, because we've spoken to you about that in the past, and we spoke to your predecessor. Over years, we've spoken to Maersk leadership about the build-up in the land-based side of the business. So how big can that become, and how much of an asset will it be at this time of volatility on the sea?
Well, I think that the logistics market in general is a $2 trillion business if you look at the world. So there is a lot of potential when your base is 15 billion. Some of it can be achieved organically. Some of it might be achieved inorganically. I think the rejigging of the supply chain that you're seeing now as a consequence of the weaponization of trade, some of the trade wars that we're seeing, and countries becoming more worried about their supply chain, it just underlines the importance that there is for us to play a role with our customers, and not having just one product that we're dependent on, but having a broader palette of products that we can actually sell to our customers. So I think it's something that has a lot of potential that we can continue to work on for many years to come. And we can see already in the results of 2025 how much this is contributing to stabilizing actually the performance, together with also our terminal business, when the shipping goes into down cycles, which is likely to continue to happen in the decades to come.
Vincent, great to catch up. Always a pleasure. Great to get your views on what is happening out there. Vincent Clerc, the Maersk CEO. OK, let's get back to the other big story that we're watching this morning outside of European earnings, and that's the tech sell-off that we've been watching. Alphabet, though, having none of it, doubling down on its AI spend.
Revenue from AI solutions built by our partners increased nearly 300% year over year, and commitments from our top 15 software partners grew more than 16x year over year.
He's not backing down, certainly not. We're going to check on what impact the tech sell-off is having on European tech. We're 19 minutes away from the open. Plenty of earnings on deck as well. The CEO of Shell will be here next. This is Bloomberg.
Welcome back. Let's get back to the earnings conversation with a focus on big oil. This is Shell. Profit missing. There is price pressure, of course, in terms of what's been happening with oil generally over the quarter. The trading business as well, not punching higher than maybe some had hoped for. The chemicals business arguably under a bit of pressure as well. So net income coming in at $3.26 billion, down 11% from a year earlier. Let's bring in the CEO of that business right now, Wael Sawan. Wael, good morning. Thank you for your time. I can ask you about oil prices, though those are pretty difficult to predict in the current environment. Let me start on the trading business then. When does that start to turn around? Is that a 2026 story?
I'd say we've had a strong 2025 trading overall. The fourth quarter typically is softer when it comes to both products and crude trading. But we've had, by and large, another strong trading year. And I would say at the end of the day, our ability to be able to create value through trading depends on, of course, macro conditions, depends on fundamentals. It is one of the strongest differentiations in Shell, I think, compared to our peers, and one that we continue to see a lot of running room. But beyond trading, I would say this was also a very strong operational year for us overall. If you look at the entire year, we delivered $43 billion of CFFO in what was a $10 drop compared to 2024 in oil price. And we've been able to really do what we had promised to do, take out costs, $5 billion plus of structural cost reductions, continue to be disciplined in capital spend and high grade our portfolio. So overall, a very good year.
Do you share the view that this is an oversupplied market and that dynamic continues this year?
We see that there is indeed a bit of oversupply at the moment, but that I would say is balanced with the significant uncertainty that we are seeing because of the geopolitical challenges, whether it is earlier in the year Venezuela, more so now Iran, the instability with the Russia-Ukraine crisis that continues to play out, and so on and so forth. So there is a premium with that uncertainty and volatility. At the end of the day, the one thing we do know is we have no clue where oil prices are going to go. So we really focus on our fundamentals, on the cost structures, on how we allocate capital, on how we continue to build that performance muscle. Because the last 3 years has been all about creating that performance culture. Now we need to step it up a gear and make sure that we take it to the next level of excellence.
Good morning to you, Wael. And as a result of all of that, you plan to return cash to shareholders. You're announcing $3.5 billion in a buyback today. How should we think about your strategy around buybacks? Because might you be challenged in getting to your return to shareholders targets for 2030? And if you are challenged, would that be because of weaker oil prices or because you want to do other things with the money? Maybe there's more focus on portfolio exploration.
Yeah, great question. I'd say we start off by not being dogmatic on where our capital goes. We really want to unlock maximum value for our shareholders. And what we see at the moment is that from a distributions perspective, we are preferentially allocating capital to buybacks because we still see a very attractive buyback in Shell. Our free cash flow yield continues to be very attractive. We see a great runway. We have a line of sight to 10% free cash flow per share growth every year between now and 2030. So being able to buy back Shell, in my mind, is a very, very good investment. To give you a sense, over the last 4 years or so, we've bought back a quarter of the company at an average price that's around 20% lower than where we are today. That doesn't mean that we don't continue to look at opportunities to be able to also invest, and that's what we did last year. 2 billion of our capital budget went into M&A, into what we would call bolt-ons in our deep water space, that contributes to our production growth in 2030 and beyond. So this is a very, very focused allocation of capital in pursuit of long-term shareholder value.
Wael, can you tell me about the conversations you have with your shareholders about gearing? Is the focus on, because for years the conversation was about keeping gearing under control for you and others in the sector. Has it pivoted? Has it changed to thinking more about portfolio longevity and investment in exploration and production? Or is it still about debt and control of debt?
I'd say it's a very balanced set of discussions. So, of course, when our net debt is where it is today, so just north of 20%, if you exclude leases, it's actually below 9%. That's a very strong balance sheet. And we like that strength, in particular, as you go into an uncertain macro in the coming years. At the same time, we're having good discussions around distributions, as I've just mentioned, and the balance of capital spend. But that capital spend has to be in pursuit of value accretive opportunities at the right points in the cycle. So I don't sense at all in my discussions with the investors that there is an anchoring on one of these three, but it's a balanced financial framework that allows us to be able to, over the long term, create value.
Well, good morning, it's Guy. Just following up on Anna's question.
Morning, Guy.
Is the reserve life of the portfolio long enough? Do you need to improve it? You're at the bottom of the pile when it comes to that metric on which oil companies are increasingly being judged. Do you need to fix that, and how do you fix it?
Yeah, I'd start by saying when we look at the growth, and just in Capital Markets Day 2025 a few months ago, we outlined actually very transparently exactly what our production profile was between now and 2035. And so I'd make 3 points around growth. I think firstly, we had identified that we needed to fill some of the gap up to 2030. And I'm pleased to say already in 2025, through some of the acquisitions we've made, plus improvement in productivity of our existing reservoirs, we have largely filled the production gap to 2030. That buys us significant time to be able to fill the gap to 2035. I'd say secondly, we had also talked about delivering 1 million barrels per day of new production between now and 2030. And this, by end of 2025, we had already delivered a quarter of that. And thirdly and finally, I think what is different about the Shell investment thesis, and this is what I very transparently talk to our investors about, is we are not just a liquids production company. If you look at our projections to 2040, we will grow our integrated gas and marketing free cash flow significantly between now and then, going from around $20 billion last year to close to $25 billion of CFFO by 2040. And that is what underpins the cash flow growth for us as a company.
OK, kind of a little bit of a kind of follow-up, but a bit of a tangent. On that line, when are we going to start to see Shell producing in Venezuelan waters?
I hope soon. We have been working previously under OFAC licenses, so a U.S. sanctions permit, to be able to look at developing offshore gas resources that potentially would be linked back into Trinidad and Tobago, into an existing LNG facility that has capacity to take that gas. We are awaiting at the moment those OFAC licenses from the US government. And within a relatively short time, we believe that we could potentially get to a final investment decision and production a couple of years after that. So I am hoping within the next 3 years we can see some of that flow. It'll be good for the Venezuelan people. It'll be great for the Trinidadians. And I think it's very much in line with the policy of what the US is trying to do. So on balance, we think we can play an important role in that space.
Well, before we let you go, the 1.5 degree Paris target is almost certainly going to be missed. Do you accept that the oil and gas industry bears responsibility for that failure?
Look, I start with the fact that to be able to achieve the Paris target that the nations of the world signed up to, it was fully recognized that we need governments, we need consumers, and importantly, we need companies to be able to play their role. We are focused on the role that we can play. So we just announced today, for example, that we are already 75% of our way towards our target of reducing our own emissions by 50%. We have made investments, we committed to make investments between $10 to $15 billion in low carbon opportunities, and we have reached that target. Our focus now is to make sure we can deliver a return on some $20 billion of capital that we have in that space. That is the objective that we have to be focused on. But that should not detract, I think, people's energy around it. We just need to continue to double down on creating opportunities that make it investable and scalable. And we see scope in multiple countries to be able to do that.
Wael, thank you very much. Thanks for your time. The Shell CEO, Wael Sawan, thank you so much for joining us. 7:53 here in London. 7 minutes until we get the opening of these European cash equity markets. Let's get to Jennifer Creary. She's got a preview of what could be on the move. Jen.
Good morning. We've got a lot of earnings to get through, and we start with Maersk this morning, the Danish shipping company reporting fourth quarter earnings and forecasting a drop in underlying EBITDA going forward. In 2025, that number stood at $9 billion. It's forecasting a drop to as much as $7 billion as well, and that's because of worsening freight rates, but also the reopening of the Red Sea channel that could upset the balance between supply and demand of shipping containers. Next up, we've got Shell. We just had the CEO on just a moment ago. Shell reporting results that disappointed analysts, reported adjusted fourth quarter net income that fell 11% versus a year ago. If you look at Shell's share price compared to BP, they're tracking fairly in line with each other. And we have an analyst saying that going forward, investors will be looking for signs of portfolio longevity. Finally, we're going to flip over to European tech. We saw a sell-off during US hours that bled into Asia hours, and that could whip around the world to Europe as well. ASML, Infineon, and also some other tech shares as well. They could have a knock-on impact from that sell-off that we saw in other parts of the world going forward.
OK, Jennifer, thank you very much. Jennifer Creary there. We will also keep an eye with London in mind on anything to do with the metals, with silver dropping quite so much. Fresnillo certainly in focus. SAAB, we're going to speak to them. That share price could be volatile at the start of trading.
It's really hard to know whether you judge today on a kind of bottom-up corporate earnings point of view or whether it's that kind of top-down macro volatility which is going to drive markets. Europe may end up netting both of those two stories out. Anyway, that's the futures picture. This is Bloomberg. Thursday morning. A couple of minutes to go until the start of cash equity trading here in Europe. What is it going to deliver, I think, is a really interesting question. Single stock's going to be super important. What's the top-down tech story going to be feeding in to this market looking like as well? What's going to be the metal story? This is what the S&P looked like yesterday. We were down by around 0.5%. What is interesting is the equal weight actually was a big outperformer yesterday on the S&P, i.e. the rest of the market outside of tech did really well. The Nasdaq got battered yesterday, down by 1.5%. What impact is that going to have into Europe this morning? Let's see what futures look like.
Yeah, at the benchmark level, to your point, Guy, you've seen resilience across European stocks. Today, futures pointing a little lower by 0.2%. We focus on the earnings story. We focus on the Shells of the world, the Maersks, with concerns for both of those companies. BNP Paribas in the banking space coming through with a beat. The FTSE 100 with that focus on miners and silver and gold, but also oil, currently pointing lower by 0.4%. Nasdaq 100 futures then, after the big losses of yesterday, currently pointing to a little bit of a revival, but not anywhere close to making up for those losses, pointing higher by 0.2%. If you put money in the Nasdaq 100 year to date versus European stocks, you'd be down 5% or up 5% on European versus Nasdaq 100. Anna, what are you looking at on a stocks level?
Yeah, let's have a look at some of those. I'll start from the bottom of this list. Let's go with defence, because we've had numbers out from SAAB. There's record order bookings in 2025. They're upgrading guidance, and the numbers came in above estimate. But some of the expectation is that this share price will drop at the open. So we'll dive into the detail there. We'll be talking to the company a little bit later on. Miners will certainly be in focus. We've seen spot silver down by down by 17% at one point, down by 9% now. Platinum also weaker. Oil prices have been on a wild ride over the past 24 hours, so we'll watch energy and miners. We'll also keep an eye on tech as a result of all of that tech selling that we saw yesterday. Will we see the likes of Relics and the advertising businesses once again in the AI focus, Guy?
Equal and opposite forces. Let's talk about that. Is the bottom-up story going to counterweight the top-down story, the macro story, the tech story versus what we're seeing in terms of earnings? This is what the open looks like this morning. So the FTSE 100 is going nowhere in a hurry. Down a little bit. There's going to be some stories around what's happening in the mining space today. There's going to be an oil story around Shell. The stock 600 is barely budging. We're down by 0.1%. Opposite and equal forces. Are they counteracting each other today? Are we seeing actually as a result lower volatility? It's really interesting to see what the single stock story development is going to be today. The CAC is up in positive territory. What's happening in the banking space? You've got BNP out there. The IBEX is down by 0.6%. Net, it comes to a very stable 600, but within the indexes across Europe, within the sectors across Europe, within the single stock story across Europe, there's quite a lot of volatility working its way through these markets. Tom, let's kind of peel the onion in a different way. Sectors, what are they looking like?
Yeah, on your sectors so far, interestingly, it's tech on the upside, up 1.2%. There's an argument you can make that ASML and others, in terms of the supply, will get a lift given the spending plans for Alphabet, 185 billion potentially by the end of this year. On the downside, basic resources, not a big surprise there, given the pressure that we've seen, as you said, around copper, gold, and most significantly in the session today, silver. So that sector down 2%. Banks also under pressure, 0.6%. On banks, it's worth noting, I think, Anna, HSBC, the redhead crossing the terminal right now, that HSBC will cull some underperformers. Cull is an unpleasant word, isn't it? Will be culling some underperformers as some bankers face zero bonuses.
Yes, indeed. So no surprise, as you say, that basic resources, the worst performing sector. We do seem to be seeing, as you've alluded to, Tom, a bit of a bounce back in technology, and that's taking along with it some of the AI losers that we've seen over recent days. So media is also a bit stronger. So WPP and Publicis are both up by 2-3%. We see some of the names like Relics, Experian, LSEG, all three of those up by more than 2%. And this is not in any sense unwinding the losses of the last couple of days, but it does look different to the last couple of days.
SAP's up 1.5%. You're seeing some of the tech stocks in Germany doing okay. Infineon's up by 0.9%, had numbers out yesterday. So, yeah, maybe there is the sign of stability. Is it derived from maybe that strong story that comes out of Alphabet? It's going to spend a huge amount of money. Yeah. Does that calm nerves? That actually maybe even just the hardware story is a little bit more positive, and therefore you can maybe calm off your nerves in the software space as well. I don't know, but maybe we are getting to the point at which some of these stocks are
is very positive. He's seeing it working for advertising. He's seeing it working for cloud. He's seeing it working for demand for Gemini. 750 million users, and that was just from December, so that number would have gone up as well in terms of the Gemini product. So yes, there's going to be some nuance here. Not every software company is going to fold in the face of AI. Some will be empowered. That is the view, at least for some.
Yeah, and that's what the line out of Alphabet yesterday. Yeah. They were giving that line. Jensen Huang kind of giving that line, pointing to some symbiosis between the two. And the market has not been trading on a symbiotic relationship between software and AI over the last couple of days.
I tell you what's getting crushed is AP Møller Maersk. The stock is down nearly 8%. It is down 8%, 8%, down 8% this morning. They don't know. Vincent was quite clear about it. The huge range in terms of what they're operating with at the moment. If the Red Sea continues to open, freight rates are coming down. But they have a real lack of clarity in terms of what that story is going to look like. Geopolitics is going to interfere hugely. And in that kind of situation, do you sell the stock?
Yes.
Is that the easiest kind of route if you have that kind of uncertainty?
Right, yeah, huge amount of uncertainty. So that's weighing on that stock. Political uncertainty is affecting the gilt market. Let's go there. The UK 2-10 yield curve has steepened to the most since 2018. And we are seeing yields at the 10-year horizon going up in the UK, up by 3 basis points. And in fact, that extends across the longer part of the curve, 30s and 40s as well. We see those yields going higher. And all of this very much attached to questions around Keir Starmer's leadership and his judgment, which we will continue to monitor.
Well, this relates to the Peter Mandelson situation. Yes. You've got to assume that if Starmer goes, does Reeves go? Do they come as a package? I think that's
been the assumption from the lobby journalists.
But I think it's also interesting detail in our colleagues' reporting of this story. The three names that are often mentioned as possibly wanting to take over, are they going to be well positioned after this story? Not necessarily. Wes Streeting, big Mandelson ally. Rayner still dealing with the issues surrounding her housing declarations and taxes paid on there. So there's not necessarily the sense that all those who've been waiting in the wings, and Ed Miliband was the other one they mentioned, but he's been very supportive of Starmer. So there isn't necessarily a sense that there's a coalition around another character. No. I mean, of course, Andy Burnham couldn't get into Parliament.
But the feeling is that if it's not now, it will be soon that Starmer will go. The May elections are coming up fairly shortly. If Labour does not do well, then there will be a growing sense. And they do seem to come as a package. So you've got to assume that the Chancellor will be changed as well. and therefore you end up with a potentially different sort of outlook in terms of what you could be expecting in the UK.
Bottom line for the markets is you're pricing in more risk premium.
Precisely.
You've been bouncing around 440 on the 10-year, and now we're above 450, and pretty significantly so. So that starts to be locked in again in terms of the risk premium for UK assets.
Risk of more borrowing, at least. Let's get another view on UK assets and what's driving them. Shanti Kellerman joins us, Co-Chief Investment Officer at Seven Investment Management. Really nice to have you with us, Shanti. So the politics will do what the politics is doing. It creates uncertainty. It creates nervousness in gilt markets that maybe we will see more borrowing if we saw a change of leadership, perhaps, or maybe even just to placate that part of the Labour Party. How are you viewing the UK political story as it pertains to markets and what it does to gilts, to sterling?
So I think the market actually quite likes Rachel Reeves. Like, you look in the press loves to hate her, but the few times where we've had sort of wobbles about her leaving, we've actually had quite strong reactions with gilts going up. So there is that stability angle. I think the other part we have in the UK is inflation hasn't been coming down quite as quickly as some other markets. December was a bit of a higher reading. So, you have the Bank of England potentially more on hold. And probably one of the bigger risks for UK investors is rates stay up and sterling stays strong. And that makes it difficult, to get your equity market returns like we saw last year with the dollar weakening. So it's definitely something we keep an eye on. I think it's hard to see, gilts going to 5.5%, 6%. So there's kind of limited downside there in the gilt market for investors.
OK, let's turn to some of the other areas of volatility in these markets. And one of those certainly is around software stocks being sold off and all that we've seen in technology. Are you ready to ditch all software stocks, Shanti? Is this the end of software and AI is just going to do everything?
No, but I think, so what we've seen in some of the big tech companies, we've started to see lots of layoffs. And they recognize that software is getting cheaper to develop because of all these tools. I think you'll probably see some of that start to filter down to those software companies with realizing they actually probably need reduced workforces. I think for companies that have very complex needs, regulatory needs, financial services companies, there is going to be a place for those software systems to do those complex things that we need that aren't simple. So probably we've had kind of indiscriminate sell-off. I think we'll probably see people picking through the wreckage, and some stuff will come back up. Other things will stay down. So it's the start of the losers from AI to some extent, which we all said we knew were coming, but then somehow we're surprised when it happens.
So it's been indiscriminate. Where are there are opportunities in software now then, given that the indiscriminate nature of the sell-off that we've seen over the last few days?
I think where the market will be is businesses that are really able to align their software offerings to tailor them to customer needs, and particularly in those more complex sectors where you can't, it's too risky to have the AI where it is at this stage go, for example, produce a customer valuation in financial services. We probably can't rely on that being accurate, and you need those, or do the tax stuff. So I think you'll see that, and also healthcare stuff where there's a lot of regulations around it. You'll see the software companies that can do those really detailed things will still have good markets, and they should be able to reduce their costs. It's going to be cheaper for them to develop and maintain their offering.
At a higher level, do you expect the rotation from growth into value to continue?
Yeah, I think we've seen that this year, and I think we don't see it as like a big plummet in tech stocks. We see it more as the rest catching up in terms of earnings. And I think we've kind of seen that with earnings season. The big Mag 7 has been, some up, some down. I think it's a bit of a fallacy to look at those like one unified group of companies because they have such different business models. And then we're starting to see, other, places like small caps do a bit better. We all know we're on like 23 times earnings in the US. Growth is going to come from earnings growth, not multiple expansion. So it makes sense that if we're not seeing huge beats in earnings, we won't see huge outperformance.
The problem is, though, that if tech comes down, is the rest of the market going to be big enough in its upswing to keep the index level static?
I don't think you're going to see tech have a big fall. I think it will be, up slightly this year, probably not a 20-30%, but I think so the indexes
can go higher?
I absolutely think so, yeah. I think this is going to be another good year for equity markets.
OK, and am I going to do better in Europe or in the United States? Is the tech story going to keep me out of the United States? Is that where I want to kind of, if I'm not seeing outperformance from tech, do I want to be there?
Yeah, so I think our markets we prefer, I think UK, Europe and Japan, I would think will outperform the US this year. Those are some of the areas where we have more in our exposure. Relative to that market.
Are you hedging that position? Are you taking more defensive positions elsewhere? Does it feel like the risk is growing? You think equity markets are going to do well this year, but the probability's got to be getting harder and sort of tougher and tougher to make those kinds of numbers.
It is, but I think we will have drawdowns. So right. and a lot of
it's going to be bumpy.
Yeah, and we had, S&P down 0.5% yesterday. So, was that what it was? So, let's have a bit of perspective.
Nasdaq was down 1.5%.
Well, Nasdaq was 1.5%. So there is that element of we forget what it's like to wake up and have those days where the market's down and see those valuations. We will have, I fully expect we'll have drawdowns this year, but it doesn't mean, we do most years in markets.
Yeah. And are you expecting that the interest rate environment stays supportive, either where it is or reduced rates from here?
I think we'll have some slight rate reductions. I think most of it's priced in, and it's probably not going to have.
So it's a bit of a side story for 2026. Mostly it's fiscal, and it's the tech story, broadening.
Yeah, it's hard to see. It's hard to see getting big compression in spreads for corporates. Maybe we get a little bit of an uplift in government bonds. Probably EM debt is probably a bright spot, and high yield, you're still earning a very good clip on that coupon, and the default estimates are pretty reasonable in that space.
Okay. Shanti, thank you very much indeed. Shanti Gellerman, co-CIO of Seven Investment Management. Guy, you're going to have a look at your...
Let's have a look at what is happening in European equities this morning. We're going to start with the single stock story. We'll kind of work our way from there. You've got defence stocks actually under quite a lot of pressure. We're about to talk to SAAB, so it'll be interesting to get its take on what we're seeing here. Chip stocks are actually doing well. ASML is up on a big spending story coming out of Alphabet overnight. That feeds through as well into Schneider, which provides obviously kit for the data centre build out. Elsewhere, Novo is soft after its big drop. No bounce back there, which I think is interesting. Lilly did really well yesterday in terms of its statements versus what we heard from Novo, which does slightly make me wonder whether or not Novo's there is this idea that Novo is kitchen sinking its numbers a little bit here, maybe, because Lilly's numbers certainly look very different in terms of what it sees in terms of its outlook. Anyway, that's the picture. Novo not bouncing back this morning. Jennifer Crew is here with more. What do you got?
Good morning. We're looking at Maersk, starting with Maersk, really slumping this morning, slumping 7%. That's after the company reported fourth quarter results, but also lower underlying EBITDA in 2026 guidance versus EBITDA in 2025. And that's really weighing on shares this morning. Next up, we've also got Volvo. Volvo's fourth quarter results missed estimates, and that's really weighing on shares as well, down 18% this morning. The company blamed weakness, particularly in North America, but also because of volatile freight rates and also concerns over tariffs as well. Next up, we're flipping over to Nordic Semiconductor's fourth quarter results actually beat estimates, up 13%. Investors really boosted by those results, shaking off some of those concerns over the longevity of AI spend and also tech valuations going forward. Finally, we're ending on BNP, the French lender, reporting fourth quarter results also that beat estimates. Those shares are up 3.5% as a result. It also raised its 2028 profitability guidance, and that's really boosting confidence this morning. Back to you.
Jennifer Crew, thank you very much indeed on some of the individual names on the move. We'll get more on the defence space as well, because SAAB is coming up. We're posting record fourth quarter order bookings. We're going to have an exclusive interview with the Swedish defence giant's CEO. A lot to talk about there with the defence spend coming through, of course, from Germany, the continued conflict in Ukraine, and all that geopolitical uncertainty. Stay with us. This is Bloomberg.
Welcome back. This is the opening trade, 17 minutes into our session, and overall, the overall number for the Stock 600 tells no story whatsoever. But there's plenty to talk about. We see the French market really outperforming this morning. We're up by 0.5% there. The DAX pretty flat. The FTSE 100 underperforms. Weakness in basic resources, not a surprise there. The tech sector bouncing back pretty strongly today. As a result, the AEX is up by 0.5%.
Let's talk about what's happening in the defence space this morning. SAAB, the Swedish defence company, maker of the Gripen fighter jets, amongst other things, reporting fourth quarter operating profits this morning. That beat the street's estimates. We've got record bookings coming through. The Swedish aerospace company also raising its medium-term organic sales growth target. We've seen that upgraded. This is 23 to 27 to 22% from 18%. Micael Johansson is the CEO of the company and joins us now. Good morning, Micael. You have You've raised your outlook. You've delivered quite good numbers this time round. I say quite good. They're strong numbers. And you've raised your outlook. In terms of that outlook raise, what are you assuming in terms of the current orders that you are going to see in that number? Is the risk actually that number could be higher?
Well, it's three components to it, I would say. I mean, obviously, we have generated growth now. The first 3 years of the 5-year plan averaged 24%. And now we have a great order backlog of 275 billion Swedish almost. And of course, that gives us confidence in generating 22% over the 5-year period, but in average 20% the last 2 years, 26 and 27. So that is sort of components in why we are raising it, the backlog as such. But still, high intensity in the market, a combination of good sort of growth on the product side, but also now success stories on the platform side. I'd like to say that the platform decisions on the contracts that we have, campaigns that we have, of course, quite political. So even though we have great offers, that is still political decisions and hard to say exactly when they come into play. But we see a good market trend. So all in all, great backlog, good market trend drives our growth.
We're really watching Canada and trying to figure out what's going to happen in Canada with the Gripen jets and whether or not we are going to see some success for you there. Can you see yourself building the Gripen in Canada?
Absolutely. I mean, we are, if they decide to go dual fleet in Canada, we are prepared to do tech transfer to Canada the way we've done it and even more, like we've done it in Brazil. And there are great industries that we can work with in Canada. So, of course, we can create a hub in Canada, but it's up to Canada to decide whether they want to go that way and create more sovereign capability in the aerospace sector. But we're giving the information that they ask for, and then it's up to them to actually take a decision on that going forward. But we could, absolutely.
So just pushing on that point, in your conversations with the Canadians, and good morning, Micael, it's Tom, are you hearing from them? Do you get any sense that they are moving towards that mixed fleet with the F-35s and the Gripens?
I wouldn't say I can sort of judge I guess it's a very high-level political decision on the Prime Minister level. Of course, lots of discussions are going on in there. Stakeholders with the stakeholders locally. What we do is, of course, have discussions on what do they need in terms of information to make the proper decision. And that we provide continuously. Yeah. So there are discussions, but it's on that level. I can't judge which way it will go, honestly.
And you produce about 20 Gripens a year? Can you ramp that up? What are the challenges to ramping up that production?
No, we could. I mean, absolutely. We're ramping up in Sweden as we speak, since we have then 3 contracts to work with. I mean, Sweden, Brazil, and Colombia. And then, of course, we have a Brazilian entity that we can ramp up a bit further. And then if we get Canada to do dual fleet, we will have another hub. And that's good because we also hopefully will get into more of a contracted discussions on Ukraine, where an LOI was signed between Sweden and Ukraine in November. So we need to ramp up. We can do it, obviously, absolutely.
Good morning to you, Micael. Can I ask you about another side of your business on the surveillance side and GlobalEye? Can you talk to us about, you've won a contract in France. Can you talk to us about the potential for other customers? Who are you talking to?
No, I think it's a great potential pipeline of interested customers for the GlobalEye, and right now it was a great win and a great collaboration will now take place with France and Sweden on that side, and I think what is imminent is, of course, to see whether there is a need for a common NATO capability, which we call the IFSC. And that is being now assessed by the acquisition authority within NATO, what to do now when E7 didn't provide the right schedule and capability going forward. So we have, of course, offered our GlobalEye to NATO to see if that can come into play. That's a big potential great thing that can happen, but I can't judge exactly when and if it will happen. But that's an example of an interesting customer. Then we have the Nordic perspective, of course. How do we combine Sweden, Denmark, Finland in terms of airborne early warning capabilities? And there are, of course, other countries as well, also in the Middle East, that's looking into this capability. And we have it in operation in UAE, as you know.
Micael, we were just showing an incredible chart showing your surge in orders, which maybe we'll put up again. And it's not hard to think of the reasons why we've seen that surge in orders from what we've seen in Ukraine over recent years to Germany ramping up its spending, President Trump calling on NATO members to do more and to spend more themselves. I wonder if conversations have shifted at all around what we saw from the Trump administration around Greenland. What's the response been, the conversations that you've been having with those who buy defence kits around that kind of drama that we saw play out in January?
I wouldn't say I see any connections to what we're doing in the European perspective to that right now. I think it's already been sort of concluded that we have a great sort of journey to do in Europe to actually increase our deterrence and defense capabilities, and every country is spending more money according with the NATO alliance commitment and what have you. And we'd started on a low level. So it's more that Europe has to take a bigger responsibility. Many countries have to spend more money on defense capabilities, and we have gaps. And it's right that Europe has to take a bigger responsibility and take care of the threat to the east. So that's what we're working with. I can't say that sort of the discussions that are going on related to control and capability at Greenland is affecting this. Okay. But I, of course, would think, can I say that the NATO alliance can do more in Greenland, and we would be prepared to, within the alliance, to provide capabilities in that sense.
Micael, just looking forward to what happens next on the fighter jet front. Everybody's trying to figure out what capability Europe is going to need and get. Got two kind of big competing consortiums in terms of providing that next fighter jet. The FCAS programme, though, is the one that a lot of questions are being asked about. That is the consortium between Dassault and Airbus. Have you had can you just update us on what your current thinking on that is? Do you see that programme going ahead? Have you had any conversations with Guillaume Faury over at Airbus on the Germany side recently? Do you see a better combination maybe to produce the next generation fighter jet than the ones we're currently working with?
We're monitoring what's happening, of course, and we're looking more at what capabilities will be needed. We have our own sort of local FCAS program together with the Swedish customer, and we are investing in autonomous capability, what we can call collaborative combat aircraft, on our own, because I think that is going to be needed. Whether that will in the future be in a partnership with a European country, I don't know. We have doors open, but right now we're pushing ahead on our own to see what happens. I have no clue what is going to happen between France and Spain and Germany in that sort of FCAS program. And I'm not intervening or trying to influence that at all. We do what we have to do, but the capability is going to be needed. And first it will be autonomous capability like a collaborative combat aircraft with the fighters that we have. And beyond that, in 2060, of course, we need something after the Gripen E, and that we're looking into already.
Micael, thank you very much. The SAAB CEO, Micael Johansson, with the latest on the earnings story, the orders story. Quite phenomenal growth there for geopolitical reasons that we understand. Really interesting conversation. Thank you, Micael, for joining us. Coming up on the programme, we'll pivot back to the banking sector. We'll be joined by Kjerstin Braathen, who's the CEO of DNB. We will be talking about the earnings story, the European rates environment, a couple of big rate decisions from other geographies, of course, due today. But we will be talking about the broad banking landscape here in Europe. That's next. This is Bloomberg.
This is the opening trade. We are 30 minutes into today's session. Given the selling pressure we saw overnight on the US, Nasdaq 100 closing lower by about 1.7%. The selling that we've seen over in Asia, a bit of resilience, really, relatively, in terms of European stocks, just down 0.1% across the benchmark. The DAX is flat. The auto sector is under a bit of pressure. We're seeing pressure again in terms of energy. Interestingly, technology is one of the sectors near the top of the list. Last time I checked, the CAC current is up 0.3%. And here in the UK, the FTSE 100 are currently down 0.2, a bit of political risk. You're seeing that in the gilt markets, down 17 points so far. Guy.
Europe feels like a kind of beacon of calm for now, but as you say, political risk may be creeping back onto the agenda here in the UK as it goes off the agenda in France. Let's talk about what we are seeing, though, in terms of the market internals. Higher 221, down 364. Tells you a little bit about the weightings and what we're seeing on the upside, because the market is fairly flat. Volume's actually fairly high, understandably, given the volume of earnings we're seeing coming through the market this morning. ASML benefiting, it seems, from the Alphabet Google story and the big spend, the huge spend, the ginormous spend. I run out of superlative spend on what we're seeing coming out of Google. ASML is a beneficiary of that. SAAB's up. We just spoke to Micael about what he's seeing in his business. Extraordinary pickup in volumes. BNP Paribas as well. We spoke to Lars a little bit earlier on in the programme. BNP numbers good. Stock up and being rewarded for that. Are we going to creep towards a ratio of 1 on that stock? BVA, though, it's not all good news out of the banking sector. It is down by 4.5% today. Shell is down by 1.85%. We spoke to Wael a little bit earlier on. But the standout story on the downside, actually, I think, is AP Møller-Maersk. Huge kind of variance in terms of what they see going forward from here. Really big spread in terms of the outlook. We just don't know what's going to happen in areas like the Red Sea, the Panama Canal. Those issues really affect that business, and the market just doesn't like that uncertainty. The stock we marked down by 5.5%, Anna.
Yeah, Guy, let's get an update on some of the geopolitical news flow, some of which could influence that sector. The US President, Donald Trump, has sent a fresh warning to Iran as US military forces amass in the region. Trump told NBC that Iran's supreme leader should be, quote, very worried ahead of talks with the United States tomorrow. In a post on X, Iran's foreign minister said that discussions between the two countries are scheduled to be held in Muscat on Friday morning. Prime Minister Keir Starmer faced anger in the UK Parliament yesterday over his handling of the appointment 18 months ago of Peter Mandelson as US ambassador amid scrutiny of Mandelson's relationship with Jeffrey Epstein. Labour members of Parliament described the mood in the governing party as febrile and mutinous. The UK Prime Minister is due to speak once again later today. And HSBC is preparing to hand some bankers little or zero bonuses as the bank seeks to emulate its Wall Street rivals with a more hard-edged stance around bonuses. Bloomberg has learned that the bank also plans to encourage underperforming staff in divisions including investment banking and wealth management to depart following bonus payouts in the coming weeks.
OK, let's stay on the banking space then, because DNB has had its price target raised by Danske Bank this morning. This after the Norwegian bank reported a fourth quarter net profit beat and announced plans for a new share buyback programme. Joining us now is Kjerstin Braathen, CEO at DNB. Kjerstin, good morning. Thanks for coming to the studio. Is this as good as it gets in terms of profitability for Nordic banks, or is there further to go for 2026?
Well, I think there are many drivers for further growth in our business. What stands out for us this quarter is a 40% growth in fees and commissions. So we have an increased diversity in earnings. And there's certainly more to build on in our investment banking and wealth management arm, where we've recently merged in Carnegie. As for NII, we expect one more rate cut, and we expect to continue to grow. We showed growth this quarter, growth in all sectors last year.
You mentioned some of the potential catalysts for this year then. What do you think is going to be the key catalyst? Is it volumes? Is it fees? Is it cost efficiency? What kind of stands out to you?
Well, I think growth in lending, for one, but we are targeting always to grow more on the fee side, and having a relatively recent merger with Carnegie taking a leading investment bank position in the Nordics, this is our expectation to be the fastest growing area.
Do you get a sense that clients are backing away from the United States? And is that a benefit for a Nordic bank?
I wouldn't use it as strongly to say that they're backing away from the United States. There is increased uncertainty around renewable projects in the US. But there has also been incentives to build activity in the US. In the beginning of last year, we saw investors turning a little bit to Europe. So I think maybe that's more the question. Can we attract more investor interest and more capital into Europe? I think yes. I'm hopeful that yes. There is a lot of investment programs in Europe, and the landscape is a bit changing, but I think US is still going to be very, very important.
Is that a home bias? Do you think your clients, both on the investment side and on the corporate side, have an increasing feeling that there is a home bias, that they should diversify back home? I'm wondering what the catalyst for that is.
Well, it's important to say that Europe is Norway's most important trading partner.
Yep.
2/3 of our trade goes to Europe, and we are Europe's most important supplier of energy. So there's a very strong interactivity and interdependence between Europe and Norway. US is less so. The biggest good that we export to US is seafood. We expect that to continue. The corporates, we see them still being active in the US. We don't see them shying away. If there's anything that we find a bit concerning is that the level of uncertainty is pushing investments out in time, more maybe than switching it from one geography to another.
Where do you see evidence of that, Kjerstin? Are CEOs just reluctant to commit on capital expenditure, or is this just a sense you get, or anything you can point to more specifically?
It's more a sense we get in the dialogue with customers. They need to figure out what is noise and what are actual signals, and that is a difficult thing to do these days. So it does point to maybe a little bit wait and see. On the other hand, you have very strong drivers in Europe related to security, still related to climate, also related to digital and technology. So it's really a matter of figuring out which of these drivers are going to have the largest impact on the economy. We believe the Norwegian economy will continue to do well.
Okay, so a lot of need for investment, but just needing a bit more clarity. Let me ask you about the cost side of your business. We were just talking about bonuses in the sector as a whole. Citi was talking about how your costs were maybe a little higher than expected. Jefferies was talking about staff costs on the rise. Is that an area that you're looking to take some action around?
We have taken action in this area. For the fourth quarter, it was very much so activity related, so costs were up in the quarter, partly of it related to the quarter, but also partly of it related to what has happened throughout the year. If you look at our cost for the full year as such, and we look at it pro forma ex Carnegie, our cost development is actually lower than inflation. So we have taken out 650 FTEs during the course of the year. We're working very hard on cost efficiency, and even with an increasing level of fee and commission, our cost-income ratio stays below 40. So efficiency, I think, is something that we're
so if you strip out
known for.
Carnegie, which is the M&A, obviously, then there isn't a cost story that you're worried about then?
No. Even with Carnegie, we're not worried about cost.
How much are you spending on AI in 2026, and is it working?
We are spending a lot on AI. We are seeing promising results.
A lot is how much?
Well, I don't have a number for you. We're spending 7.5 billion on tech, and we're diverting increasingly more on that on AI. But I don't think for us as a bank it is about spending the most money. It's about building competence in the organization. We have 3 sort of flagship projects where we're using this towards customers. We are exploring how to innovate in the KYC area. But we're also focused on where are the bottlenecks and what will be difficult. And number 1 is data quality. We're putting a lot of effort into that, so you could call that AI spending. And also culture and people and leadership and leading change.
Because, Guy, we were talking to BNP Paribas CFO, and he talked about know your customer and using AI for that as well. But arguably a little bit more definitive in terms of his view, in terms of the efficiencies that might come through from AI. But it's really interesting to hear how
it's a series of banks that talks about KYC as being an area they see. Actually, it's that kind of matching, that kind of due diligence you have to do. Maybe AI solves some problems there. The bigger picture around all of this is, are white-collar jobs safe? Like, what is happening? Are you going to change the way you spend on software? Are you going to spend differently in terms of people? Are the traditional white-collar jobs that society has relied on going to be there going forward? As you think about the bank, not now, but in 5 years' time, in 10 years' time, how different does the employment picture look?
I think it can be extremely different, and I believe the transformative power in this is very substantive.
For the good or for the bad?
Well, I think for the good and the bad, but I think AI needs to be regulated, and I think one of the uncertainty is what will be the pace of change in the employment market. We've talked about not making changes to our hires of young people, because I think that is one of the starting trends that we see, and I think as a society we need to engage in going after the productivity gains, going after the customer value, but we also need to be mindful of what will be the impact of society. It's not easy to regulate, but our desire is that we have competent authorities that actually manage to regulate.
Yeah,
because this is powerful.
So aside from the regulation, Kjerstin, but in terms of the implementation in a bank, you've talked about data quality, and clearly you need the data to be of a quality to be useful to AI. You work in a very regulated industry as well. Do you think that the market sometimes overestimates how quickly change can come in industries that are very regulated, operating often on quite legacy systems?
I think regulation is one thing, complexity is another, and banking is quite complex. And I think, as usual, there might be a risk that we overestimate in the short term and underestimate in the long term. We work on the longer term, and building competence, preparing our people is part of that. But of course, what we can do now is working with unstructured data. So what we have done on KYC so far is to double the productivity in the last year. Now we're looking at it completely fresh. How would we do this today? And then you can start questioning, do you actually need the software? Do you need the processing tools? Maybe not, because if your data is good enough, you can module and create the layer on top with AI, which completely transform the process. But that isn't done in 3 months or 5 months. But that is more what we're looking for. Well, my team is telling me that we will have promising gains and impacts during the year of 2026. We've been at this for a couple of years already. But I'm more thinking about 3 to 4 years to really start seeing the bigger impacts, because I think you have to do the groundwork. And I think it's interesting also talking to the larger tech companies when they talk about what is the most difficult things, it's people and culture. So this is no magic dust either, even though we might sometimes like to talk about it.
Yeah, people and culture, and that can be quite nebulous, can't it? DNB CEO, thank you very much indeed, Kjerstin Braathen, on the earnings story, but also the AI impact as well. That stock currently down a little over 1%, but up about 30% in the last 12 months. Coming up, what has Alphabet got planned in terms of capital expenditure for this year? It is a big number, we'll reveal. And if you've been listening at the top of the show, you should know the answer, but we'll give it to you again after the break. AI. This is Bloomberg. Welcome back. Now, before the break, we asked what is Alphabet's planned CapEx spend for this year? At the top of the range, the answer, as much as $185 billion US. The Google parent company, of course, expecting to spend for the year a total that's more than it spent in the previous 3 years combined. $185 billion. They are not retreating from the CapEx spend. It comes, of course, as Alphabet's fourth quarter sales, excluding partner payouts, hit more than $97 billion, beating the estimates. Alphabet CEO Sundar Pichai says his company's success is being fueled by demand for AI products, including its Gemini search assistant.
Today, more than 120,000 enterprises use Gemini. Gemini Enterprise managed over 5 billion customer interactions in Q4, growing 65% year over year. Revenue from AI solutions built by our partners increased nearly 300% year over year, and commitments from our top 15 software partners grew more than 16x year over year.
OK, we were just debating as to whether or not Sundar sounded a bit automated in that response. But look, the numbers were good for Alphabet. The market response was a little choppy. The cloud unit doing really well, growth of almost 50%. They're supplying the TPUs, their own chips, to Anthropic. They have Gemini, of course. And what they're seeing is 750 million customers. They seem to be hitting the mark, Alphabet. It sounds like I feel like Guy wants to jump in at this point.
No, I think just having the stock flat last night was in some ways an amazing performance.
Yeah, absolutely. I mean, given what we've seen in the rest of the tech space of late, and let's get to that to talk about AI, tech investment, what we're seeing in software stocks, the VC landscape, importantly. And let's bring into the conversation Anish Acharya, who is general partner at Andreessen Horowitz, and we are very pleased to have you with us today. Fantastic that you're here this week because there's so much to talk about.
Timing.
Yeah, absolutely.
Yes.
So we seem to have spent the last few days thinking about what AI means for software.
Yes.
The market has spent the last few days thinking about that.
Right.
The market has decided very quickly to sell software stocks.
Yes.
Has the selling been too indiscriminate? How would you characterize it?
Absolutely, it's been too indiscriminate. The market has oversold software. So if you look at it, number one, nobody is vibe coding their payroll. That is a future we're not going to live in. 8 to 12% of enterprise software spend today is on software. That is not going to be subsumed by vibe coding. The stakes are so much higher for the rest of the spend. number one. Number two, if you look at prices for SaaS companies, 75% of the public names have raised prices since ChatGPT was released. So all the signs, and then Google's quarter, which was exceptional. All the signs are proving and sort of indicating that we're oversold software.
Okay, so they're not vibe coding. So you're saying
correct.
There's a room
not their payroll.
There's room for specialist software that's dedicated to the job at hand. Is that what we take away from the year?
I think that the incumbents are highly capable in many of these markets. CrowdStrike is a very capable incumbent. ServiceNow is a capable incumbent. They have the right to win and deploy AI within the workflow and the customer base that they have today, and I think the market's missing that.
Does it help or does it hinder your ability to pick winners and losers in this environment?
I mean, we're in the job of the micro, and a lot of the things that we think about are new emerging markets versus what's going to happen with established markets. If you look at the entrance of Google, that did nothing to Microsoft in terms of their dominance with their Office products, right? Search was a completely new category. So often when we have these product cycles, what we see is that the incumbents do better in their existing markets and they're irrelevant in emerging markets. We're mostly focused on the emerging markets.
There's been a long debate amongst VCs and founders about what happens when the models start to push higher up into the verticals. And we got a reminder of that with Anthropic and the plug-in in terms of legal services this week. What does that mean for the companies the startups that do the wraps around the models? How defensible are those kind of businesses?
I think the wrapper story is overtold. So if you look at the labs today, they've done a formidable job of building out their models, but there are many categories in which you want to be multi-model. That is number one, right? Number two, if you take a look at the feature surface that's implied by many of these software products, so you can do meeting transcription with AI, and many AI companies do that, but the correct product is to build spreadsheets, to build a word processor, to build a slides product. So there's just an enormous amount of software to build around the capability, and I don't believe the labs are going to prioritize both the capability and the software stack.
Let's go back to the beginning. Your sense is that the markets have overdone it? That we've pushed, that we're pushed too far on the downside?
I believe so, yeah.
Okay. Isaac Kim over at Lightspeed. Technology private equity in its current form is dead.
Yes.
That's
totally disagree. We've said this so many times. We said that new media was going to kill old media, yet we're sitting here today, right? Yeah. How many 30 years after AOL Time Warner? We said the PC was going to kill the mainframe and data centers. More data centers than ever, and guess what? Mainframes are still relevant.
Okay.
Yes.
You don't think so private markets haven't over-allocated to software?
No. I don't believe so.
100% sure on that.
There's going to be an enormous flood of software. In fact, the world is short software today. Look at all of the industries in which software has not been a relevant player. Look at legal, for example, right? We've got maybe a $50 billion software market. We've got a $550 billion overall market. Yep. Legal is infrastructure for capitalism. There's no way that is one-end market.
So worried?
Well, I mean, I'm not going to talk about day-to-day stock prices, but I think the market has overreacted to the perception that vibe coding is going to cause enterprises to rip and replace their SaaS spend. They're just not.
Just on the legal piece, so the Legoras and the Harveys of the world, these companies that build these legal options with AI embedded, they are defensible from the kind of product that Anthropic's putting out? That motor's deep enough?
I absolutely believe they are. I think what Anthropic is doing is product marketing more than delivering product capabilities that are vertically oriented to that market. And if you look at legal, it's an industry, not a market. It is too small to say that this is just one end market. This is an industry that's going to have many winners and many submarkets within it.
Does this also mean that the infrastructure spend that we're seeing and those commitments around CapEx, that's all rational, that all makes sense as well?
Look, without speaking to specific companies' infra spend, what I will say is look at OpenAI's announcement this year, right? They said that they tripled capacity, they tripled revenue. So what we're seeing is every time they bring supply online, you're seeing 100% of it allocated by demand.
Do you worry about OpenAI, given the progress that Anthropic's made on enterprise and the progress that Alphabet's made? They're invested in, of course, by Andreessen.
Look, so far what we're seeing is prices are going up, not down, and we're finding all the foundation models are finding their own directions to specialize in, right? So Google's done a really nice job on their multimedia models. Nano Banana is excellent. Anthropic's done a nice job on coding models. And OpenAI, ChatGPT's 950 million weekly actives.
It wins on consumer.
So far.
And they'll pay. And will they pay? How much will they pay and when will they pay?
I mean, if you look at the top SKUs of these companies, right, Gemini Ultra is $250 a month. The top ChatGPT SKU is $200 a month, right? Grok Super Heavy, $300 a month. We've never seen consumers paying these prices for software before.
So whilst we're busy talking about software and worrying about software going out of business and white-collar jobs, what should we be thinking about? What is the tech story that we are missing because we're too busy talking about this?
Look, I think the world is short software. Software is a huge both productivity driver and it's a deflationary force. This is how we get to 10% GDP. That sounds wild, but I think that it's possible.
Sounds exciting.
It is when you say the world's short software, you mean something else other than that.
That's right. I mean, it's oversold. There's not enough software in the world, and we're going to see more of it. Yes.
Data center build out.
Yes.
Too much of it, we're going to end up with a glut. The prices need to come down. What's your view?
All I can tell you is that the biggest sort of companies that are investing in data centers so far are seeing 100% of the supply they bring online be allocated. So far it seems like a wise investment.
So far. That's now. What about going forward?
I mean, what is the sort of market and demand that is latent today for intelligence? That's what we're talking about. So I don't see a slowdown in the near-term future.
Okay.
Anish, thank you very much. Really great, well-timed conversation. Anish Acharya, General Partner at A16Z. I'm supposed to say Z, I'm sure, aren't I? I really can't. I really can't. Let's pretend I didn't say it. Thank you very much for joining us, however it's said. Let's talk about what is coming up in your trading day ahead. Bloomberg's Skylar Montgomery-Koenig joins us, and the daybook shows lots of central bank decisions, Skylar, neither of which are expected to generate a move in interest rates. So what will we be watching for?
Yeah, I mean, particularly the Bank of England is usually more likely to generate excitement than the ECB. And the contrast today is also that we'll get forecasts from the Bank of England and we won't get them from the ECB. For the Bank of England, we're really paying attention to what's the vote split. So the expectation is 7-2. If you have more voting for easing than that, it'll likely be taken as dovish, especially given that you only have 5 basis points priced in for March. So that can certainly rise. And you're also looking at the forecast, whether or not that big inflation fighting measure we have from the budget in November feeds into those forecasts and to what extent.
How are you feeling about tech?
I mean, I'm not as negative, I think, as the market is. It's been really interesting because you've had tech come down at a time when earnings have actually been quite strong. So the net impact is, as you've had tech not do very well, derating. So on a multiples basis, you're something like 6 points down from around a year ago. And at some point, you'd think that there will be buyers for that market.
You think?
You're coming from a place of over-positioning. So we're seeing a rotation. And that certainly could extend, given that it was quite a long stretch that we had tech outperformance. But I think generally for the equity market, it's encouraging that you do see rotation, not just broad sell-off.
Is silver a new risk barometer for the broader markets?
I think it's something we certainly need to be paying more attention to because it has ricochet impacts everywhere. And so when you have something that's super over-owned, particularly when it involves retail, what you'll see is if there's a sell-off there, it starts to impact other markets that are retail-oriented. And I think today, too, with the tech market, you're seeing specific stocks that are more retail investor based. And so, the silver sell-off might be a precursor to that, or it might just be people going, I need to sell this because
Bitcoin kind of used to play that role. For a period of time, we watched it as a risk barometer, risk on, risk off. It's not and Bitcoin's not playing that role.
Yeah, I mean, I think it's a question of where do people want to be putting their money now, because Bitcoin didn't protect you on a number of big sell-offs or with a number of big events where they're going, there needs to be another way to position, and silver and gold have kind of risen to that role. Gold in particular, it makes sense from a historic perspective. Yeah. Silver, it seems like it's more of just a spillover from what can't end up in the gold market.
Okay, Bloomberg Online, Skylar Montgomery-Koenig, thank you very much. Indeed, it's been a massive week, a massive day and a massive week for earnings. We're going to get more in terms of the CEO reaction. We're going to be speaking and hearing from Qualcomm's CEO. A bit of pressure on that stock around some of the pricing concerns and smartphone delivery. 4:50 p.m. UK time, so stay tuned for that conversation.
Absolutely. Again, what have we learned today? AI is, they're talking about it. Executives are definitely talking about the impact that it's going to have on white-collar jobs and their businesses.
And we're still talking about software a few days in, even if the market looks a little bit different on that story. Tech stocks at least higher this morning. That is it for the opening trade. The Pulse is next. This is Bloomberg.